Home Finance 101, your credit scores, how they affect your loan approval process, and how to improve your credit scores. Let's get into it. Your credit scores play a major role in determining your mortgage creditworthiness. Here's how they do it. First of all, your loan approval itself. The higher your credit scores, the lower the risk you appear and the better credit risk you are for investors. Conversely, if you have low credit scores, if you don't pay your bills on time, investors are going to look at your credit scores and it's going to be a higher risk and it's going to affect your ability to get a loan approval. Second, it's going to affect your interest rates. The higher your credit scores are, the lower your interest rate's going to be. Conversely, the lower your credit scores are, the higher your interest rate's going to be. Your loan terms. Your lower credit score borrowers may be required to put a higher down payment down than higher credit scores borrowers. And next of all, your actual loan amount. If you have lower credit scores and your interest rate's higher, it's going to cause your debt to income to be a little bit higher, thus causing us to have a lower loan amount. So it's going to affect your loan amount as well. How do we improve your credit? One, make sure you pay your bills on time. If you are short some funds this certain month, your minimum payments on your credit card is $25, just make the minimum payment. Don't miss any payments. Even if you just have to make the minimum payment, do that. Second, to improve your credit scores, pay down your balances. If you have a $3,000 credit limit and it's maxed out at $3,000, your credit scores are going to be worse, even if you pay your bills on time, than someone who has a $3,000 limit with only $1,500 on it and make their payments on time as well. So outstanding balance as opposed to your credit limits, that's going to affect your credit scores. Try to keep your balances at 50% of your credit limit. So if you have credit cards that total about $10,000 in credit, try to keep a balance of $5,000 or less. Ultimately, if you can do 30%, that's going to be the best credit scores for you. So your balances as opposed to your limits, that'll help improve your credit scores with lower balances. Avoid taking out any new debt when you're buying a mortgage loan, when you're buying a home. Any new credit inquiries will drop your credit scores. It might cause problems with your DTI, so don't have your credit pulled when you're applying for a mortgage loan. Check your credit regularly with credit sources just to make sure nobody's stolen your identity and caused any problems with regards to your credit scores. And most importantly, be patient. If your credit cards are all maxed out and you get a nice tax return and you pay those down, it's probably going to take 2, 3, maybe even 4 months to see that impact on your credit scores. So just be patient. Ultimately, a strong credit score is a valuable asset and will save you thousands of dollars on your mortgage loan. It'll also save you thousands on car loans as well as credit cards. So try to keep your credit scores up as best you can, make your payments, and get those credit scores up. Like, subscribe, share. Let's get started with home ownership today at jameforloans.com. Thanks for watching.